Hi, welcome back to part 2 of JPMorgan v Chinese internet stocks. This time, we'll go into the specifics of the JPM report regarding the entire basket of these Chinese internet equities and see exactly what were the drivers that changed their opinion in a short span of just 2 months. So I promise you, it's a lot more interesting and insightful compared to those lame news reporting on Bloomberg or even Yahoo Finance. But you have to promise me something too. You have to like that smash button and please give me at least 10 likes to continue motivating me to do such videos. Anyway, I've managed to get my hands on the actual JPM analyst report itself, so I'm actually not too sure whether I can divulge it in whole or even in parts. So I'll just be sharing some interesting analysis and observations made by Mr. Alex Yao and his team, and of course adding in my own commentary alongside so that we can publish this video as my own thoughts. Wink wink. First, I would just like to paint the context for viewers who have not actually saw the initial note published by Alex Yao and his team on that fateful Monday, 14th of March 2022, a day before the bottoming, quote-unquote bottoming hopefully, unless we continue with this trajectory of falling off the cliff for the basket of Chinese equities. So JPM actually outlined their investment framework in 3 key stages. Stage 1. The share price declines and valuations derating as global investors cut their exposure to Chinese internet due to the quote-unquote hard to quantify risk. Stage 2. Share prices stabilize once global investors sell off a bets. Stage 3. Global investors start to re-engage with the sector once they feel comfortable with the sector's external risks and fundamentals. So let me first qualify that I hold the exact same view as JPMorgan on how investors should think about the entire Chinese internet sector. So I'll be the first to admit though, I have royally screwed up in timing stage 1 of this cycle. So I have always thought that we were already in stage 2, where there was a certain degree of stability in the $100 to $120 range for Alibaba specifically, since I pay such close attention to that clown stock. But yes, looking back, how stupid and naive was I to think that that was the end, and the bear market lasted for more than 15 months, and it seemed like there is no end in sight. So I was still thinking to myself that when Alibaba was at $100 then, which dumb is still selling and the market showed me sub $75. I guess I'm the dumb. Personally, I would add in an additional checkpoint, stage 2.5. So in my personal view, given how things are developing in today's economy, there might be, keyword might, there might be an option for the Chinese government to essentially support the economy and the financial markets with strength. I believe there have been a lot of analysts and a lot of projections stating that how interest rate might be decreasing, how they might pump certain forms of liquidity into the economy itself, but the Chinese government has always been very slow to act, at least in this 2020 to 2021 crisis. So honestly, at this stage, everybody is just smoking hopium. However, if we were to draw past experiences from the 2008 crisis, for example, during the Great Financial Crisis, the Chinese government was extremely quick to act. So is the crisis this time different? I don't know. And I believe that only the top senior economic advisors in the CCP can give you an exact answer. But clearly, if you are just judging based on the actions of the Chinese government, they don't think that the upcoming quote-unquote recession or famine or deleveraging is a very serious issue to begin with. So that's their assessment. We shall see how things play out. Now, this quote-unquote bailout from the Chinese government is of course pure speculation on my end, but I did furnish this short note on my Discord chat a few days ago, so quick plug, you can join my Discord and also my Substack email list if you haven't done so already. None of it is paywall, so don't hesitate. Link in the description box down below. Now, JPM also cited several developments such as the State Council meeting with Liu He's announcement and also the active discussion between the regulators on the HFCA Act, which is the Holden Foreign Companies Accountable Act, and also the gaming monetization approval resumption, which led them to believe that the Chinese internet sector might have entered into the second stage earlier than they have expected, comparing the 2 months time frame that happened versus the 6 to 12 month forecast they predicted some time ago. So personally, I don't think anything has substantially changed actually. The constant reiteration from the senior Chinese officials, the Oscar performance from both the CSRC and SEC counterparts, these were actions that have been rinsed and repeated since the latter part of last year. In fact, if I were to compare December of last year and today, we have a more worrisome problem today because of how fragile the economy is looking worldwide. So unless we start taking some concrete actions to show support for both the local economy and businesses, boost consumer confidence and sentiments, and of course the relaxation of measures, I don't see how companies can benefit from this constant reiteration. All talk, no action. Don't misunderstand me. I do believe in the law of attraction to a small extent, but you don't just keep manifesting it by saying with your mouthpiece and not doing anything with your hands and your legs. So the market needs more tangible reassurances. Also, an important point to note is that 2022 is not 2020. COVID will impact earnings differently from now compared to then due to three main reasons as JPM cited. Number 1, logistics and supply chain networks. Number 2, gaming supply. And number 3, consumers' willingness and ability to spend. So I also wanted to include this table presented by JPM on the report itself on how they actually expect the two COVID quarters in China, namely Q1 and Q2 of 2022, to impact the different e-commerce sales growth. So the current expected projection for Alibaba is actually negative 4% in Q1 and negative 8% in Q2, while JD and Pinduoduo is expected to hold relatively stronger growth. That being said, under their sector investment strategy, specifically for e-commerce, their order of preference is still Baba, then Pinduoduo, then JD. It goes to show that in investing, numbers only tell one part of the story. You have to always look at the resiliency of the business, especially in bad times like today, future prospects and expectations, valuation, idiosyncratic considerations, etc. Don't buy just because it's growing and sell because it's not. Tencent. Most of us probably invest based on expectations, and clearly Chinese companies are recently in the dumpster, but investors like myself remains highly optimistic of their future and recovery, even though in the near term, it's clearly extremely painful. So on top of that, JPM also cited their attempt to translate the impacts of common prosperity to private enterprises, which was an exceptionally popular term in the Chinese investment world just a few months back. So they drew case studies on China telecom and gas sector in their attempt to trying to quantify the impacts of harmonizing corporate strategies to a new regulatory framework that the CCP is trying to construct, suggesting lower long-term margins or return on invested capital, which is quote-unquote understandable, and will also probably drive lower long-term valuations. That being said, this is kind of offset by the better alignment between stakeholders, reducing the intervention risk by the regulators, and also increasing earning sustainability. So I think to this commentary, I only have two main comments. Number one, I think drawing comparisons between the internet sector by and large and versus the telecom and gas sector will yield a very inaccurate projection because the telecom and gas sector are quite a natural monopoly for those of you who took Economics 101. There would definitely need to be more synergies between the government and also the companies in those said sectors, which are natural monopolies, due to the nature of the business and the industry. So the internet sector, on the other hand, will require probably a higher degree of autonomy and also higher degree of quote-unquote capitalism. And if I can frame your thinking in this way, because of the sheer speed of innovation and competitiveness, and ByteDance is a classic example of what I mean by being competitive. Sure, I understand the outcome of this analysis on trying to draw lessons from those said industries about being government affiliated or being more cooperative to the government. But I think the rules will be different and it's not as readily applicable here. Number two, a so-called quote-unquote better alignment between the companies and the governments by and large might not necessarily result in a reduction in intervention risk. And the regulatory cycle is a feature, not a bug of the Chinese system. I always like to flesh out this graph to show my foreign viewers. This is just a heads up for potential investors. So recently, I've also seen many online debates about how this recent lockdown and mess China is in today might actually benefit e-commerce companies specifically, as we have seen in 2020 and 2021. And if you were to extrapolate the results linearly and just copy and paste, we should be happy as shareholders. I think this time it might really be a little bit different. So three potential reasons as laid out. Number one, the overall consumption environment in China has severely weakened since 2021 due to multiple macro headwinds. You have your tightening property market, you have more prudent investments from companies and venture capital arms, you have more stringent hiring and cost-cutting exercises by all these tech conglomerates, and also the collapsing of certain industries such as gaming, education, streaming, etc. Hence, the expectation for a strong consumption demand rebound post-lockdown might be a lot more mellowed down compared to 2020. Number 2, the online penetration rate has reached 30% in China if you were to exclude automobile and gasoline, and this gap has since significantly narrowed past 2020. Number 3, the emergence of new e-commerce players are coming in hot from Kuaishou to Douyin, and they've matured and adapted by a large extent post-2020, and I believe they have learned many valuable lessons then. That being said, I think the recovery will normalize in Q3 or Q4 of this year, not barring the fact that there is a 69th wave of infection in China again, and it is also of strategic importance for the government to essentially try to ring-fence and boost consumption demand recovery. So if you have actually enjoyed this breakdown and a sneak peek of the JPMorgan report, remember to leave in the comment section down below for part 3, where we will look through more attentively on their comments specifically to Alibaba and Alibaba only. Smash the like and I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!